Hello, hello, hello. Good afternoon to everybody here joining us today. My name is Zandile Chiwanza. I'm a personal finance journalist and a financial wellness educator based in Toronto. And I'm so excited to be here today. And I have a special guest with me today. I have Jessica Moorhouse, who is a millennial money expert, speaker, accredited financial counselor, and the host of award-winning podcast More Money Podcast. Thank you so much, Jessica, for joining us today.
Thanks for having me. I'm so excited to be here.
Yes. So, thank you everybody for joining us for this wonderful session. It's going to be investing, all about investing. We're all badass investors in the making. Shout out to Wealth Nouveau. Definitely support this message. And we just want to get right into it. We're not going to waste any time. We have a lot of questions, and feel free to put some questions in the comment box as well, because we want you guys to learn as much as you can about investing, okay? And Jessica's our expert, so let's lean on her. And so, my first question, I want to know about your investment journey because we all have to start somewhere. So, let's take it back. Tell
Mm.
me how you became an investor and how that is showing up in your life today.
Yes. So investing was never something that we talked about in my family. So I knew saving, and that just meant like putting cash in a bank account. Investing was never a conversation. So I actually even didn't realize you had to invest your money to save for retirement. I just always had these questions like, how am I going to get $1 million for retirement? Like, that doesn't make sense. I guess I'll figure out the math later. Um, And so when I started educating myself, reading books and blogs and stuff like that, then it was revealed, oh, there's a thing called investing in the stock market, the bond market, and things like that. And so my first kind of entry point into investing was, I think, in 2010. So I graduated university in 2009. 2010 is when I finally got a job after a year of unemployment because of the fun little recession that happened. And I actually kind of just took the lead of my older sister. She's 3 years older, and she started using this platform called ING Direct, which is now Tangerine. And they offered an online way, like at the time, the only way to invest in a portfolio of investments, is a portfolio of index mutual funds online. And as a millennial, I'm like, oh, this is great, convenient. I don't have to go to an office and talk to some guy in a suit. This is great. I had no idea what the portfolio was built. I just knew it was investments. I'm like, cool, that's great. That's all I knew.
Mm-hmm.
And so I
Mm-hmm.
used them for a number of years. And it was actually pretty good timing. I couldn't afford to invest a lot. I was not earning a lot. I think it was $200 a month is all I can afford, but I knew it was important to start doing it automatically and create that habit. And then gosh, I should know this, 2017. mm, I got married at some point. What year is it? 2021? I think I got married at 20. When did I get married? I don't remember. It's been like 8 or 9 years. But anyways, whenever we got married, I'll find out what that date is. I literally cannot remember. I've been with my husband for like 14 years or something like that, so I can't remember. But it was eight
He'll
years ago
forgive
we got
you.
married. I know he'll forget me. We started talking about our finances together, and he had investments at one of the big banks in a portfolio of mutual funds. And I'm like, oh, mutual funds, I've heard of those. My mom and dad do that. So I think that seems like the smart, adult, responsible thing to do. So I'm going to move all of my money out of Tangerine and move it to this big bank in mutual funds, still not understanding what exactly I was investing in. Did that for a number of years. And then I started getting really serious about personal finance. I started taking some, formal courses through the Canadian Securities Institute, and then started recognizing what I'm actually doing and what am I doing wrong. And one of the big things I
Mm-hmm.
didn't realize was I was in a very conservative portfolio. I was in these mutual funds that had very high fees, and I wasn't really getting, I think, the advice that I thought I should be getting through our advisor at the time. And so I took kind of the initiative to really learn everything I did not know about investing, which was a
Mm-hmm.
lot. And then that kind of took me on a journey to learn more about index investing, couch potato investing, passive investing, whatever you want to call it. There's lots of different names for it. And
Mm-hmm.
then I moved my money to a robo advisor, and then just this year I moved everything to a discount brokerage to do DIY investing. So it's been a journey of investing and not knowing what I'm doing to a point where now I definitely know what I'm doing. And now I also teach others how to do it as well. Because everyone, like, I've talked to so many people who did the exact same
Mm-hmm.
thing as me.
Wow. So you literally went through that entire journey from not knowing anything to doing DIY investing. And how
Yeah.
long did that take, would you say?
Honestly, I'd say it's only been in the last 5 years that I've been like 5 years ago is when I really started getting comfortable about making choices on my own behalf instead of looking to an advisor who is telling me, "You should do this. You should get into this portfolio." Just be like, "I guess they know." That was when I really took control and started understanding, like, things like diversification and asset allocation and risk tolerance and things like that, and how to create your own
Hmm.
investment plan. So it's,
Hmm.
really fairly recently, but that should also just goes to show that when you do take the time to learn the things that you don't understand, the concepts, the terminology, it actually doesn't take that long to then understand it. I think a lot of us think that, oh, I don't have the time. It's going to take me years to understand this. It does not have to take you years. It really doesn't.
Hmm. That's such a good point. But I want to take it back to, you know, you mentioned a lot of words that maybe not
Mm,
everybody understands. And we're going to get into that because jargon is definitely a barrier in all
yes.
finances, not just investing. But, for someone who, and I'll be honest and candid, I'm definitely just started investing this year. So I'm a
Hmm.
newbie, but, that's something.
Hmm.
So I'm learning here
Yep.
too. For someone who hasn't started, what is the first thing that they should do to
Mhm.
get started?
Mhm. The number one thing, and I hear so many people think, oh, it's just about getting started. Just, invest some money and see how it goes. No, don't do that because you're playing with real money, right? You want to
Right.
first make a plan, just like with your budget and your savings goals, like saving up for a short term goal, like going on a trip. The same thing is for a longer term goal, like investing for retirement or something like that. And so the first thing you want to identify is what is your investment goal? Why are you
Mhm.
investing? And when you take a step back and actually think about it, you may actually realize, oh, well, I actually have a few different goals. I want to save for retirement. I want to save up for a down payment on a home, and I don't want to just leave it in cash. I want to invest that money so it grows because real estate keeps going up and inflation is high. Maybe you have a child or children and you want to save up for their college, tuition. And so then you would look into investing in their RESPs. You can have multiple goals at the same time. So it's important to identify what are all of those goals. And then you can kind of move past that and then start answering some other critical questions, such as, okay, we know the goals. What is the time horizon for all of those? And that just means what's the timeline? What's the due date? So for
Mhm.
retirement, you would be like, okay, well, I'm 30 right now. I want to retire by 65. That's a time horizon of 35 years. I've got 35 years to invest my money by the time I'm 65. So then I can start withdrawing funds slowly and living off that income. That's your time horizon. For like a
Mhm.
home down payment, maybe it's like 5 years. So now we know 5 years. Why a time horizon is so important to identify is because the makeup of your portfolio will be so different, if it's a short-term goal versus a very long-term goal. And what that means is most likely you will be in a more risky or more aggressive portfolio if you are investing for retirement compared to something shorter like a 5-year goal. And then that kind of leads me to asset allocation and risk tolerance. So I'll start with
Mhm.
risk tolerance first. Risk tolerance simply means it's basically the psychological impact of investing. So, how comfortable are you with volatility and just the ups and downs you may see in your portfolio? Someone with a
Right.
very high risk tolerance means I can see my portfolio drop by 20 or 30%, and I'm not going to freak out and want to withdraw all of my money. Someone with
Mhm.
a very low tolerance for risk will be like, that's absolutely not me. I don't want to go through that crazy roller coaster of emotions. I maybe am okay with maybe a 10% drop or something like that in my portfolio. That's something helpful for me. And why that's also important to know is that will have an impact on ultimately what asset allocation you have in your portfolio. An asset
Mhm.
allocation means what is the mix of stocks and bonds in your portfolios, also called equities, stocks, and fixed income bonds. So when you have a big portion of your portfolio that is in equities or stocks, that will ultimately mean that you will have a higher chance of expected higher returns. More risks you take, the higher the likelihood that you will get a higher return in your portfolio. But
Right.
also, there's going to be more volatility. It's going to go up and down, like we saw in March 2020. If you were all like 100% in stocks, your portfolio most likely dropped by yeah, 20, 30%. It was very hard
Hmm.
to stomach. But if you're like, no, I don't want that. My risk tolerance is not that high. That means that you're going to want to have a higher portion of, or not higher, but like a good balance of bonds in your portfolio or fixed income. So maybe having something like 70% stocks and 30% bonds. So all of these, characteristics are so important to identify before putting your money anywhere and even deciding, should I work with a wealth management company and they can manage my portfolio for me, or should I use a robo advisor, or should I go self-directed or DIY investing on my own?
Wow, right. So this is before we even get to the numbers. There's a series of
Yes.
things that we need to
Yes.
identify. And is there a way to identify your risk tolerance?
Oh yeah. So one way that you're kind of forced to do that is if you do try out a robo advisor, like you can do basically the opening of the account, or even before you open the account, you can go through what's called an investor questionnaire that they force you to go through, so they can then identify what's the right portfolio for you. And you're asked a series of questions to determine, okay, what is your risk tolerance, your goal, your time horizon. They give you a few scenarios to find out how you'd react to really find out what your risk tolerance is. But also, there's a ton of free investor questionnaires by lots of like the ETF providers and stuff. Like Vanguard has one. If you just Google, investor questionnaire Canada or something like that, there's going to be a ton
Hmm.
that pop up. Try out a bunch of different ones because they're all different questionnaires. They may give you a different result. And then
Hmm.
ultimately you get to decide, okay, what am I the most comfortable with? But the other thing too is, even if you get a certain result based on your questions, it's important to actually go through that process at least once per year to see if anything's
Hmm.
changed. Has your goal changed? Has your personal risk tolerance changed? Like, quite honestly, what I find is a lot of people who start investing are very, kind of scared, because it's very new and they're
Right.
like, oh gosh, I don't want to lose any of my money. Why would I want to lose my money? I don't have a lot of money. And so you sometimes I see a lot of young people start pretty conservative, but then as they get more experience and more comfortable with investing, and they take this questionnaire again, they may actually reveal that, oh, I actually have a higher tolerance for risk. Like for me, when I started, I was in a pretty conservative portfolio. And over the years, I've actually made it more aggressive because I've been more comfortable with the risk that I'm taking because I understand what that means, what are the consequences, and how I'm going to react.
Hmm. That's so important. You're talking about that level of comfort that you have, right? At the end of the day,
Yes.
it's about you, not what your portfolio is
Mm-mm.
saying, right? So really checking in with yourself. I love that you mentioned that. So now
Mm-hmm.
we've done these steps before. How much do I need to actually start? Is
Mm.
there a rule of thumb? Is there, you know, guidance? How much do I need to put aside to
Mhm.
actually start investing?
Yeah. So really you don't need a ton of money. I feel like in the past, like honestly, a decade ago when I started learning about investing, it was a very different
Hmm.
landscape. You did, depending on what kind of avenue you wanted to take. So typically, if
Right.
you want to invest in a portfolio of mutual funds with the bank, and that could be actively managed mutual funds or index mutual funds, they're two very different products. Typically, you need at least $500 as your initial contribution. And then usually they stipulate a minimum contribution. So if you want to make regular contributions, usually it's like, okay, it's got to be a minimum $25, nothing less than that. For
Hmm.
robo advisors, pretty much you are required to, some of them don't have a requirement for an initial contribution. Most of them do have a minimum of $1,000 to start with, but then they don't have a requirement on a minimum of contribution. You can do $10 if you want. For
Right.
discount brokerages, if you want to open up like a Questrade account or something like that, and do your DIY investing, buy your own stocks and ETFs, do whatever you want. Also, most of the time, the minimum is $1,000, sometimes up to $5,000. So it really depends on the platform that you choose. So that's kind of the rule of thumb, is take a look at the platforms and the options. But I always say have at least $1,000 saved up before you start investing. And then I should also preface, before you start investing, of course, it's important to do all the things I mentioned in creating that investment plan, but you've got to
Right.
make sure you've got that financial foundation nice and organized. Have that fully funded
Yes.
emergency fund. Get your debt under control, whether that's completely paying it off or just have a debt repayment plan that you're working towards and you're paying off your debt. Have that
Right.
nice and organized before you jump into investing.
Right. And that actually brings me to a question about, if I have debt, should I still invest?
Yeah, that's a question I
Okay.
get all the time. And I think because The traditional advice in the past was absolutely not. You're not allowed to invest until you're fully debt free. And the
Hmm.
landscape with like carrying debt has changed so much because so many of us have debt, whether that is
Right.
consumer debt or, student loans. I mean, pretty much everyone our age has student loans still. Even people my age are just still paying off their student loans a decade later.
Hmm.
And so I don't think it's realistic to be completely debt free before you start investing. That being said, there's definitely different types of debt that we want to take care of. So for high interest debt, that's anything like I'd say above 20%, I would say
Hmm.
focus on that. It is very difficult to consistently earn that kind of return on your investments. I've seen a lot of finance gurus talk about, oh, if you just pay the minimum balance on your credit card and invest it instead, you'd be ahead because you were investing. And stock market's been crazy. If you just invested in
Hmm.
like the US stock market, you can get returns of like 25%. That is not normal. This has not been a normal
Hmm.
year. You cannot
Right.
expect 25% returns every single year. If you look really at historical returns over like a 10 or 20-year period, really we're looking at between 8 and 10%. So that's why I
Hmm.
say if you've got high interest debt, focus on paying that down first. And then if you have lower interest debt, so anything below 20% or 15%, and that could be your car loan, student loans, line of credit, whatever that is, just make sure
Right.
you do have that debt repayment plan. You've got that due date or that deadline where like we're going to be debt free by this time. You're actively trying to pay it off quicker. And then, yeah, then I think you're totally able to start investing.
Okay, amazing. So that definitely is a myth that I've seen before. So it's good that we have that balance where
Hmm.
if you do have some
Hmm.
debt, check in with whether it's high interest, low interest, and go from
Hmm.
there. So
Yeah.
if I'm investing for my retirement, because that's a big goal and that's a goal that a lot of
Hmm.
us have, should I use my TFSA or should I fund my
Mm.
RRSP instead? And what are those, just
Hmm.
for everybody's sake, maybe just explaining a little
Yes.
bit?
Yeah. So the two types of registered accounts that we as Canadians have access to is the TFSA, that stands for tax free savings account. And then the other one that's been around for a lot longer and that we're more familiar with is the RRSP, excuse me, that stands for Registered Retirement Savings Plan. The TFSA has only been around for, I mean, just over 10 years. It just got launched in
Hmm.
2009. So I feel like there's still not a lot of people that recognize that is actually an investment account. A lot of people, because
Right.
of how it's labeled, tax-free savings account, just think it's for cash. You can put cash in your TFSA if you want. You could also just put cash in your RSP. But the best way to
Hmm.
use these registered accounts is to invest your money. And so how they work is a few different things. Let's start with the TFSA. When you contribute to your TFSA, you build up that contribution room over time. Every year, everyone gets the same dollar amount, a contribution room. But what's great is so you would contribute, whatever your available contribution room is, and you can find out what your room is for both your RRSP and your TFSA. If you go into your CRA My Account, make sure to log into that account to see what the available contribution room is. I think most people have no
Hmm.
idea how to find that out. And so you contribute after tax dollars. And what that just means is when you make a contribution to your TFSA, you do not get a tax deduction like you do with an RRSP. So it's you've already, earned that income, you've paid your income tax on that income, and then you're contributing to your TFSA. But the beauty of a TFSA is that whenever you contribute to your TFSA and say you invest it in a portfolio of ETFs or stocks, it grows. If you want to withdraw that money, number one, there's no penalty for withdrawing and there's no tax. You do not pay tax on the growth or the dividends you earn or the interest you earn on the money inside your account. So it's pretty beautiful. And not
Hmm.
only that, let's say we're kind of near the end of the year, let's say you want to withdraw $10,000 from your TFSA. Granted, no, there's no penalty, there's no tax. You get that same $10,000 you withdrew, that contribution room, back the beginning of the next tax year. So you get that extra $10,000 back in 2022, which is really great. So it's very
Hmm.
flexible. And that's why I'm a big fan of TFSAs for people who are just starting out, younger, and they're maybe not, settled in their life and careers. They don't know if they're going to live here or there, if they're going to switch careers. They want some flexibility. And they also
Hmm.
maybe are not at an income level where they really need to lower their tax bill. They're not in the really high tax bracket, so they don't need the tax deduction. So TFSAs in general is usually where I would say this is probably where you should start. Again, everyone's different, but that's kind of general. For an RRSP, they're a great vehicle as well for retirement savings because they make it difficult for you to take that money out, which is good. I think
Right.
some of us TFSAs can be tempting
Some
because
of
you
us
can
need
make
it.
those withdrawals. Right? We need
Right.
kind of that
Hmm.
barrier to be like, well, if you make a withdrawal from your RSP, there is a withholding tax. So they do withhold some money for income taxes. You also never get that RSP room back the next year. Once you withdraw,
Okay.
it's gone forever, which is why, in general, we don't want to touch our RSP. Again, the biggest benefit of an RSP is you get that tax deduction room. So as you progress in your career, your income level rises, and you're like, well, I want to lower my tax bill. I'm getting into a high tax bracket. What can I do to lower that tax bill?
Right.
Then you can contribute to your RSP. So, as someone like me who's self employed, it's been such a great way for me to figure out, oh, how do I pay less taxes? Because I'm the one that has to make sure I set aside money for taxes. The other
Right.
important thing to understand is a TFSA really is like a tax free savings account where you make a withdrawal, it's tax free. So a RRSP is a tax deferring account, which means it's not tax free when you take that money out. Like I mentioned, there's a
Right.
withholding tax. You're just deferring taxes into the future. So what usually happens is you invest in your RSP until like 65 or something when you want to retire. At a certain point, you are forced to convert your RRSP to an RRIF, a registered retirement income fund. I believe that's 71. Um, but when you do want to start making those withdrawals, then you do have to pay tax. You have to pay tax at your full marginal tax rate. But the logic is that, throughout your lifetime, you're saving a ton of money from those, tax deductions. And when you're retired, you're going to be at a lower tax bracket than when you were in your working years, because number one, you can kind of control what your income is because you're not earning new money, you're just living off of your savings. And
Hmm.
so you'll be at a lower tax bracket. So when you withdraw those funds, you're going to be at a marginal tax rate.
Right. Thank you so much. There's obviously a lot of information. So if anybody
I
has
know.
any clarification questions or anything they want to follow up on, please drop it in the chat and we can either address it now or later on and keep the conversation going. So when it comes to, I know you are self-employed, but if I have a pension with work, do I still need to
Mm.
save on my own for retirement?
Great question. So, if you're one of the lucky people that has a pension, and also I should preface, there's two types of pensions. There's a
Okay.
defined benefit pension plan and a defined contribution pension plan. The one that we typically call golden handcuffs, or like the really good juicy one, is the defined benefit pension. And people that are in that pension plan, usually they're, work for the government or some sort of private, company, educate, my mom's works in the school district, so she gets that. So we don't
Hmm.
see them a ton if you work in like the public sector. What usually, if you work in the public sector, you're going to be looking at a defined contribution pension plan. They're still great. But what's great about the defined benefit pension plan is what's defined is how much you get in retirement. So you can really kind of predict how much you are going to get when you're retired. And it's also
Hmm.
guaranteed for the life of your retirement. Awesome.
Right.
Like, honestly, defined benefit pensions. I wish I got one, but I'll never get one. Defined
Yeah.
contribution plans are still good because it's still a pension plan. Your employer will contribute some money to it. You contribute. So you get that matching from your employer, free money from your employer. But it's not defined. Your contributions are defined. So what's defined is we know how much you're going to contribute and your employer does, but it's not guaranteed how much you'll get in retirement. So, but
Right.
with that said, you might be like, should I even participate? Absolutely, because of that employer matching. So you're basically getting 100% return on your investment because you're getting a dollar for dollar match from your employer. It's
Right.
free money.
Right.
So many people take too long to really opt into that program. Another similar program to DCPP is a group RRSP. Similar in
Hmm.
that there's usually matching from your employer. So again, it's free money. Now, what's really important to note, if you participate in your employer's group RRSP or a pension plan, those contributions from both you and your employer, they do take up your RRSP room. Right. So I think
Mm.
lots of people don't realize that. So it's like they do eat into your RSP contribution room. So it's
Okay.
important to really track that, make sure you don't over contribute. But with your original question, okay, if I've got a pension or a group RSP, do I still need to save for my own retirement?
Right.
Absolutely. Absolutely. And maybe it isn't about, really focusing on your RSP. Maybe it's really focusing on your TFSA then. But absolutely, because don't we want to grow our wealth to an amount that makes us really comfortable, not just like the
Yes.
limitations that your pension plan or group RSP have? So absolutely, you should be definitely investing on your own, because also you want to have that flexibility too if you want to leave your employer. You don't want to be like, oh, I
Right.
have to stay with this employer because they've got a good pension plan. What if you decide to
Right.
switch careers or just leave that job?
Right. That's such a good point. And do you have any advice for people who are not working, like for an employer and are self-employed, on how to save for it, to invest for retirement?
Yeah. So that's the thing. When you do have a group RSP or a pension plan, it kind of lessens your burden in terms of how much you personally need to save for your retirement. If you do not have that, like myself, that means the burden is 100% on you. That being said,
Mm-hmm.
remember, there are a couple government programs that we will get access to when we're retired, such as the Canada Pension Plan and also the Old Age Security Plan. So we do get some, free money. We do kind of pay for it in our taxes, or we contribute to it in our lifetime. Nothing's really free, but we do
Mm-hmm.
get that. But that's why it's really important to, take a look at some retirement calculators that will take those government programs into consideration, and then we'll kind of spit out how much do you personally need to save. So
Right.
basically what I'm trying to say is, if you're self-employed or you don't have a kind of program through your employer, that means that you really do need to take care of it yourself.
Right, right. And I mean, what are your thoughts on? I know you mentioned robo advisors and gave us some examples, gave us examples of brokerages, sorry, discount brokerages.
Hmm. Hmm.
What are your thoughts on robo advisors? What is it? Can you give us some examples?
Hmm.
And why
Yeah.
would those be good for people to use?
I am a big fan of robo advisors. Like, they've only really been around, gosh, since maybe 2013 or 2015. Like, they have not been around for a while. That being
Right,
said, they're an amazing, I think, innovation in the financial industry, and just making it more accessible for people, especially young people, to start investing. Because, like I mentioned, when I started, my only options were, ING Direct. They were the only online platform, and they only offered like three portfolios into index mutual funds. So it was very restrictive. Or
right,
you had to go to a bank or an investment firm. And sometimes investment firms won't work with you if you don't have much money. And the banks, they got like lots of high fees and stuff to be aware of. So robo advisors are great because they give you that access. It is a way that you can go online, you can start investing, you can contribute. They rebalance and manage your portfolio for you. All you really have to do is make your initial contribution, and then set up, regular contributions, or you could just do it manually, lump sums throughout the year, whatever that makes most sense. I always kind of like making it automatic, having those regular contributions, making it easy for
right.
you. But that's do. It's very easy to set up. And how a robo advisor works, and there's maybe like 10 or so in Canada, maybe 9 or 10. Um,
Mm-hmm.
they're all fairly similar. So how it works is they have these menus of pre-built portfolios that are full of index ETFs, exchange traded funds. I'm going to say a lot of jargon. I apologize, but that's what they are. An exchange traded fund is a very similar product to a mutual fund, and that's as a pool of investments. You're investing in a lot of different companies, so have these pre-built portfolios, so you don't have to worry about that. You just have to go through their questionnaire. They will spit out what they think is the best appropriate portfolio for you, and then all you have to do is then invest your money and be patient and see it grow. It's really hands off. So for that reason, I think it's a great option for young investors. Again, that was what I chose to switch to out of mutual funds, because I wasn't at the time comfortable doing DIY. I'm like, I don't know, I don't want to mess it up. I don't want to make a mistake. This way is a
Right.
very easy way to get into it. And
Mm-hmm.
then maybe as you get more comfortable with investing, that's maybe when you want to explore self-directed investing and managing your own portfolio, or not. Like, a lot of people are busy with their responsibilities and families and stuff. Robo-advisor might just be, the perfect kind of mix of accessibility, and also like there's not a lot of work on your part.
Mm-hmm. So you mentioned robo advisors, doing it yourself, which you're doing. What about if I want to work with the financial advisor or planner? Is there anything I should
Mhm.
keep in mind or any questions that I should be asking because, want to go in and at least have some kind of information? And what
Yeah.
what would you say is good to ask or to know?
Hmm. Well, I'd say that's a really important thing to identify what is their title and what is their role. There's so many different fine titles, especially in the financial industry, like advisor
Right.
with an O or an E, or planner, or my credential is accredited financial counselor. Then there's money coaches. So there's lots of
Hmm.
different titles, and so it's really important to understand, okay, so what does that mean? What does that mean? That, what's your background,
Right.
what's your experience, what are your credentials, what does your title mean, what kind of services do you actually offer? So for example,
Right.
I'm usually a big fan of using, say, a robo advisor for your investments, and then to get a
Hmm.
solid financial plan for yourself, working with what's called a fee only or advice only financial planner. They
Right.
You pay them a fee, and sometimes it can be a little bit pricey, depending on who you work with, but then they provide you with a solid investment, or they can actually do a little dissection of your investments and give you some advice on that. But then they provide you with
Right.
a financial plan, giving you some really solid advice, but they do not sell you any products. And I think that's the really key thing, is a lot of the people that we seek advice from are selling us something when they're giving that advice, so they're not totally unbiased. And that can be kind of a conflict of interest, really. I don't know why the
Right.
financial industry is the way it is, but that's how it is. So it's really
Right.
important to understand, okay, how are you getting paid? What services do you offer me? For example, a lot of sometimes, advice only planners will manage your portfolio, and they will
Hmm.
charge you basically a percentage of the value of your portfolio. And that can be kind of pricey. So it's really important to understand compensation and the services that you're offering.
Okay, great. So, thank you so much for all the information you've been giving us so far. I know that everybody is taking it in, and we just want to open up to the audience for some questions at this time, just to see what everybody's thinking. I mean, with so many people talking about cryptocurrency,
Oh gosh.
NFTs, taking
Hmm.
that level of risk, we have a few
Yeah.
questions, and they all involve
That.
that actually. So we have here from Chasia. I'm sorry if I'm pronouncing that incorrectly, but she says they say they finished paying off debt, still working on an emergency fund. Does that mean
Mhm.
I shouldn't start trading? I'm making good money now and opened a Wealth Simple Trade TFSA account and put $1,000 in.
I would personally, Mike, it's so it really has to do with your personal comfort level, and also maybe the security of your job. If you're like, my job is very secure, I'm not worried about getting laid off and not having enough money to kind of pay my bills to keep me afloat until I get onto EI or something like that, or before I
Right,
find my next job. But for me, my comfort level has always been, and usually what I recommend is like, wait until you have that fully funded emergency fund. Maybe that'll delay you investing for a few months, but then you can kind of rest easy that you've kind of ticked all of the boxes that you're supposed to before really diving in. Because the truth
right,
is, you start investing, and especially if you're using, Well Simple Trade, which is a discount brokerage, and you start buying ETFs and stocks, you may lose some money. And that
right,
does not feel good when you start investing and you immediately see exactly, you're like, oh, I invested $1,000, now it's worth 800. That doesn't feel good.
right,
And so I
right.
feel like having that solid financial foundation with that fully funded emergency fund is the best way to kind of get started.
Right. And I think just to add, I think balance too, right? So you can still save for your emergency fund and continue trading. Like you can put a little
Yes.
percentage towards both, right? So
Hmm.
thank you for
Hmm.
that. Thank you. So we have a question from Erica who says, when investing, would you also include NFTs? And what is an
No.
NFT? What is an
So,
NFT?
yeah, no, I knew we were going to get questions about NFTs and cryptocurrencies. So, when we're looking at different assets to invest in, cryptocurrency, NFTs, I mean, even some meme stocks, quite honestly, those are what are considered alternative investments or just speculative investments. They should not be the thing that you dump all of your money into, because they're very volatile. They're very kind of unknown. I mean, and there's honestly, this is the thing that breaks my heart, is there's so many scams out there. I've seen so many people like, oh, I got rich off of some coin I've never heard of, and then you find out a week
Right,
later it was a scam. So you've got to be very careful with those types of things. Usually what I
right,
recommend is, when you're investing, it's really important to have a diversified portfolio. I'm a big fan of ETFs specifically, but index mutual funds are also a great product. Having that as your core portfolio, And then maybe giving yourself either a percentage of that portfolio, like 5%, maybe 10% if you really want to, or a specific dollar amount to then kind of play around with some more speculative investments or alternative investments, like things like cryptocurrency and NFTs.
Right, right. So similar to that, we have a question from Natalia. It says, when you recommend $1,000 to start, does this include investing in cryptocurrency too?
No, no, it doesn't. No. So it's the reason I said $1,000 is let's say if you want to open up an account with like, Quest Trade, which is a discount brokerage or robo advisor, in order for you to actually utilize them, they require you to have $1,000 as your like initial deposit. So that does not
Right,
include like having just $1,000 already invested in like a cryptocurrency wallet. I mean, it's like, no, you have to give them $1,000 to start using their platform.
right, right. So is there a percentage allocation that people can look to for cryptocurrency and other alternative investments and in your
Mhm.
portfolio as a whole?
I'd say between 5 and 10% for anything that's considered an alternative investment.
Okay,
But
okay,
when honestly, when you're a beginner, that is not where I would start with because it may honestly, the volatility of those alternative investments, they just, I mean, it's like every week, it's like, it's up, it's down, it's up, it's down. It's crazy. It may
right,
honestly scare you off investing entirely. So that's why I kind of feel like an approach that is a little bit slower and maybe into things that are, more recognized, like exchange traded funds or mutual funds or something like that, is a good
right.
approach to start with. And then as you get more comfortable, then you can kind of dabble into those alternative investments.
Okay. And so if I just started investing and the stocks are going down, 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 what should I
Mm,
do? What can I
yeah.
do?
Well, yeah, what can you do? I mean, there you've got two options. You can freak out and cash out and then realize your capital loss, which means you definitely lost money because you cashed out. Or you can do nothing and just wait for it to go back up. Now, it's different when you're in a portfolio of say ETFs and we see like the market, dip. I know it did in October and lots of people were like, "Oh no, I've lost some value." I always tell people if you're in a diversified portfolio of like index ETFs, you just hang tight, keep contributing because maybe you're buying now at a discount. You just wait for the wave to go back up. If
Right,
you're in individual stocks, it's harder to predict because very well maybe it has lost value and it will never go back up. So that's why
right,
I'm not personally a big fan of investing in individual stocks. Again, like for me, I do invest in individual stocks, but that is a specific portfolio. I keep it to 5 to 10% in my overall portfolio. So if I lose money, it's okay. It's not going to affect my retirement. I've got my core portfolio that's all tucked away. So individual stocks is a bit different because you could potentially like wait for it to go back up. And
right.
typically the advice is if you're going to invest in individual stocks, you've done your research, you believe this has growth potential, hang on to it for at least 3 to 5 years. But again, there are, stocks that looked great and then they went down and they never go back up. So it's
Right.
that's the risk that you take.
So we have one last question from our audience here. How can I find an unbiased financial advisor? Any key
Mhm.
questions I can ask them to make sure they're not helping me just to make their commission?
Yeah. So that's again going back to why it's so important to ask what services do you offer and are you selling me any products? How are you compensated? So find out are you paid on commission? Do you get bonuses? Because sometimes, you'll talk to an advisor like, oh no, I don't get a commission, but they'll get a bonus or they have quotas that they do need to fulfill in order to keep their job. So they're still incentivized in a certain way. So really
Hmm.
understanding that. But quite honestly, it's like basically try working with someone who does not work for one of those big financial institutions that sell products. Work with someone who can't not sell you a product. The only thing that they are selling to you is their advice. That is kind of my 2 cents on that.
Right. Well, okay. What are some of your recommended resources for beginners to learn about investing? As we kind
I'd
of wrap
say
up here, where can we start?
yes. Yeah, I'd say like an easy entry point is there's so many great podcasts out there, even Canadian specific ones like my own. So that's a great way just to kind of passively start learning about all of this terminology. And then there's some great, entry point books that I always recommend. One of my favorite books that really made things click was a book called Millionaire Teacher. The author Andrew Hallam is Canadian, and it was a great inspirational book, but it really kind of put the pieces together for me. Another great one by a Canadian is called Wealthing Like Rabbits. That's a really great one. There's actually a lot, and that's the other thing I haven't really touched on. When we're learning about investing, a lot of the information out there is from Americans, and sometimes
Mm-hmm.
then you didn't have to translate for yourself for a Canadian. You're like, wait, we don't have 401ks, we have RRSPs, and so it's
Right.
important to take the relevant information and then remember that we do have different systems. So it is really important,
Right.
I think, to also find Canadian voices, Canadian authors, and stuff like that. But podcasts, YouTube can be good, but you got to be careful. There's a lot of people that are just talking about hot stocks and like you're like, I don't know if I trust you. But books
Right.
and is the best place to kind of start.
Amazing. Well, thank you so much, Jessica. This was really helpful. And I'm sure that a lot of people will have more questions and look for you. But this was a great opportunity for us to chat. So thank you so much again. And hope everybody enjoyed this session.
Thanks for having me.
So, hello, Andrea. Welcome to the Beyond Money Summit.
Thank you so much for having me.
Of course, thank you for joining us for the How I'm Doing It segment, where we're talking to women like you who are building businesses, securing generational wealth, and spreading really financial empowerment, because what you do definitely lends to that. So, tell us a little bit about what you do.
Sure. So I'm a business lawyer. I'm the founder of Henry Business Law and the